You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Coming to you live here, and if I sound a little bit different, it's because I'm coming to you from somewhere different. I'm coming to you from scenic and sunny Washington, D.C., in particular, the JW Marriott here in Washington, D.C., for the annual Securities Traders Association National Conference. A lot of things on the docket, hardcore equities, a lot of it, but also some options, and a little bit of crypto sneaking in. You can't escape it. It's everywhere these days. So a lot of stuff going on down here. It'll be hitting the network soon, so hopefully you're keeping an ear open for it. You'll see a lot of interviews coming from me here very soon. And also joining me on the old program today, joined by the magic of technology. Let's see who we got here. First off, let's go to a little bit outside of our studio, where indeed we are joined by Uncle Mike Tosaw from St. Charles Wealth Advisors. Uncle Mike, welcome back to the program. And a little birdie has told me that you are now indeed 1 year closer to death. Well, congratulations.
Well, thank you very much. Your little birdie's correct. So you got some really good birds. Make sure you feed them some good bird seed today.
Now, to be technical, he's only 1 day closer to death. Just, the years being marked.
Yes, that is technically true.
Only a day has passed.
Take solace in that, Uncle Mike.
It's 1 day a milestone day. You're only
and you never know with
1 day closer to death.
With medical technology advances, that day could be ever farther retreating in the distance. So you never know.
Maybe you'll be like that. What was that movie with the robot where the kid puts his brain into the robot?
AI, is that the one?
No, not AI. It's like it's got the kid from it's got the Indian actor, and he's and it's a robot. Chappie.
Oh, I never saw that one.
Oh, you would like that one, Mark. No, you're a sci-fi guy.
On that note, I'm going to reveal the title to my next book now. On that note, Getting Younger with Age.
I like it.
There you go. There you go. Well done. A little bit of a positivity. Speaking of positivity, he usually isn't a font for positivity, but you can hear him there joining us. The Greasy Meatball, Mark Sebastian, coming to us, not from D.C. Who knows where he is? Parts unknown. Mr. Meatball, how you doing? Where are you beaming in from, sir?
I am beaming in from one of the 10 towns that changed America. Beautiful Riverside, Illinois. Scenic, gorgeous, former vacation spot to the movers and shakers of that downtown Chicago.
Never heard of this Riverside you're speaking of. All right. With the team assembled, let's dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody, welcome to the Trading Block. And oh, what a day of trading it is. I go away for a couple of days and you guys break the markets without me. What the heck is going on? Here we are coming into middle of the session here on Thursday, October 4th, and all the major indices are firmly in the red. S&P off about 1%, Dow off about, actually just ticked 1% on the Dow as well, and tech-heavy NASDAQ taking a drubbing off 2%. All this red means green. On the vol space, VIX cash soaring up to about over 15 actually today, 15.19 here at the high on the day. We're hovering, right around 1475 or so right now, but still well north of where we were on the last show. Several handles out there. Our old friend VXX north as well, trading right now right around 2789, up about 1.7 handles out there as well. So volatility giveth, volatility taketh away, the market giveth, and the market taketh away. It's in taking away mode today. So gents, I've been knee deep in market structure and options and cryptos and all sorts of fun stuff down here. So what did you guys do? Who broke my market? Let's start with the meatball, sir. What did you do? Did you break something? Mr. Meatball, you there, sir?
He broke his microphone.
He broke his microphone, I guess. All right, so we're going to flip that. Mr. Uncle Mike, we'll start with you. Did you break my market, sir? I accuse you. J'accuse.
I must have got the wrong memo. I thought you had a bunch of VIX calls. I was trying to make it go up for you. So I screwed that up. I'm sorry, Mark.
Oh, it's all right. I'll get over it.
No, hey, I was muted. Did you know that? I was muted.
We figured as much.
We figured that out.
Yeah. Yeah.
Go ahead, Mark. Take it away.
It's interest rates are, we talked about levels not mattering in interest rates, but speed mattering. And what we're seeing is a increase in speed of the rate in which interest rates rise and bonds lose. We're finally starting to see some of the risk we talked about for 2 years in junk debt, as HYG, for instance, looks like it's under a bit of pressure. So this is all bond market related.
And what's catching your eye since you talk about it a lot over there in your precious VIX zone, sir?
VIX is what's interesting is we got this great move in VIX today, but there was, and we talked about this in vol views last week, there was such a wide spread between the VIX cash index and the VIX futures that your names like VXX, the VIX futures themselves, are not moving like you would expect. This feels now, based on kind of the way everything was pricing itself, it's setting up for kind of a one-off-ish. I would point out that VVIX, the VIX of VIX, is skyrocketing today and was, like 86 at the low yesterday and now around 100. So there's definitely demand for VIX options today.
That's where things get spooky. When VVIX starts to float around the triple digits, that's when things get a little bit weird. Speaking of demand for VIX options, I'll have to pull it up here. Our good friend, the Flow Master, Mr. Schwartz, putting it out here today. He always has good data on all things VIX options. And here we go. Yeah, this is the highest level since June. We're seeing right already, just partway through the session in VIX options, 500,000 contracts in the first 2 hours alone. So the ADV, listeners, just for a frame of reference, the ADV is well shy of that. It's like 450 or something, or in that range. So baiting the ADV just in the first 2 hours, calls outpacing puts, as you might imagine, about 5-2. So not a lot of love for VIX puts, I should say, out there today. No surprise there. But interesting stuff out there as we're lighting it up. Of course, I'm sure we'll get into more of that tomorrow on the old vol views. But Mr. Uncle Mike, sir, what's catching your eye out there in today's market maelstrom, sir?
A couple things for today. This might be bond related. So I think what Marx is saying, it could be, but I don't know. I'm not going to confirm with him yet, but it's definitely something that it could be. So what I'm seeing right now today, it's just a pullback right now, or it's just not even a pullback. It's just a down day. And let's look at a couple things right now. Bonds are down, stocks are down, metals are down. And with all that in mind, usually when we have everything down and the only thing being up is the VIX for the most part, I mean, there's some other things that are up. Financials actually are up slightly on the day. This to me feels like just, not to sound too oversimplified and blunt, just more sellers than buyers today. Now, with that being said, if you do have leveraged option premium on the table, meaning if you're short some puts and you're levered on them, or you're short some put spreads, or if you're long some calls, whatever, and you're leveraged on them, you need to respect risk. I did, and I'll talk a little bit more about that in the strategy block today. Actually, my birds tell me I'm doing a double strategy block today. I'm kind of excited about that. But when we're looking at everything on the grand scheme of things, everything's down. A lot of times when you see everything down in the major asset classes, something's going to come back up tomorrow or the day after. I don't know that for sure, but a lot of times it does. So with that, the money's got to go somewhere. And if it hasn't appeared where it went yet, I think it's going to appear somewhere tomorrow or early next week. So that's kind of what I'm seeing on the day. I do think it's interesting that financials are still up technically a little bit on the day. So that is something to take a look at. Also, when looking at this, we do have, I believe, a strong level of support on the S&P, roughly 15 to 20 points down. I'd have to look again, but we bounced kind of off that support. What was the highs back in late January, we bounced off those levels when we were there a couple weeks ago, and we still have another 15, 20 points to go before we touch that. If we go down there, I think it's going to be a pretty pivotal time for the S&P, and that we'll have to go down to another level of support if we're going to do it, or it could bounce off of there. So I think that with those factors in mind, along with it being October, crazy things do happen in October. Crazy things happen every month of the year in the markets, but historically, a lot of crazy things have happened in the marketplace during the October time. We have a lot to look at over the course of the next couple of weeks. And we do have non-farm tomorrow, not to get too ahead of myself with around the block, but we do have that. And on a side note, little known fact about today, it is National CB Day, 10-4. Back to you, Mark.
What's your 20 there, sir? Oh, yeah. It's
National CB Day.
One of the towns that didn't change America, at least according to Mr. Greasy Meatball there. So I don't know, maybe St. Charles did. They made some fancy pickles, and they certainly beat the heck out of it.
I can tell you what they did. St. Charles definitely changed Mike Tosaw. He went from it turned him into a apparently it's got such a culture as to be a black hole in that it prevents those that live there from leaving.
Why would you ever leave?
Exactly.
Because they have delicious Skippies gyros, and of course lemonade, also very forgotten component of Skippies.
Indeed,
gyros and lemonade. I mentioned earlier that the Nasdaq taking it on the chin, and we are seeing that quite extensively out here today with a lot of names. Netflix off 15 handles. We're also seeing Tesla off about 15 handles as well. That's about 5% for Tesla and about 4% for Netflix right now. Also seeing good old Softy off about 2.5% or about 3 handles. Uncle Mike's beloved fruit company, good old Apple, off over 4 handles and nearly 2% out there as well. So the drubbing being felt just extra hard out there in all things Nasdaq tech land today. Uncle Mike, is the worm turning for you on Apple, sir, or is it still not enough for you?
No, today's just a down day. It feels like the sky is falling because of the fact that the market's at such high levels that a 35-point drop in the S&P over the course of the last 15 years or whatever, it seems like a lot just because of that point value. But the reality is that we're a little over 1% to the downside. And so if you were to go 5 or 6 years ago, this is like a 10-point down day in the S&P. So I think today it's, obviously respect the market, manage your risk accordingly, but it's a down day. That's all.
Nothing to scare Uncle Mike Tosaw today. He's just going to roll some puts.
I would point out that we're starting to see a little bit of backwardation in the overall market, which is can be a sign that, we're getting a little worried.
Yeah, as speaking of worried, I mentioned all those tech-heavy names. I know they're attractive to a lot of your crazies in your pitch chat. What are they slinging out there today, sir?
We actually spent most of the day looking at S&P, looking at VIX, and what was interesting is SIBO is taking it in the chin. Have you taken a look at the stock price of SIBO? It's amazing. You can almost correlate the day SIBO stopped being an official sponsor of VolViews to a top in the stock price.
I think there is something, actually, a correlation there.
So
1-to-1, I think.
I don't know if you'd put that together, but it almost correlates to the day. But on a day like today, as you said, VIX is getting a huge pop in volume, and SIBO is getting punched in the face. That is one that we were playing around with as potential trade. I mean, listen, I know that there's a shadow over some of these lawsuits that are probably baseless, but I just don't see, with the amount of growth that they, with an event like this likely stabilizing VIX, I think it's gonna have a pretty decent bullish flag on the next move higher.
Yeah, I think there is definitely a correlation, 1-to-1. You let the lawyers take charge, and all of a sudden things go to hell. That's what happens whenever the lawyers run the ship, as unfortunately is the case over there right now with all these legions of lawsuits over there against the old mothership of VIX. We had an interesting chat with the folks from SIBO just before I got on the show here, so you'll look for that on the network. Come in soon. Since we're looking at sell-offs and all that fun stuff, we thought we'd do a little bit of our old Google foo. We like to do that every now and then to see what people are looking for out there in terms of broad Google search interests. We found some interesting nuggets in the past, like the fact that Andrew and the state of Maine are single-handedly the options search mecca in terms of per capita interest in options. I think 98% of that coming from a little town on the coast there, from a certain one-eyed person who shall remain nameless. This time we went a little bit broader. We thought, let's just look at the Google data for simple things that your average Joe might search for, and he wants to hedge himself, like, let's say, stock market hedge, something basic like that. And if you do that data, you run it all the way back to 2004 in the old Google machine. You find, obviously, the high point's going to be pretty much what you expect, October of 2008. That kind of pins the needle right at 100. Remember, these charts go from 0 to 100, 100 being the most interest, obviously 0 being none. The other high points, August of 2007, 97 there on the chart. Dece of 2004, 95. And February of this year, February of 2008, actually, 84. This year, actually, February didn't really blow it off to looks like it goes in the high 70s, which is right now it has ticked up a little bit as we're up to about 58 right now. So starting to get up there, was in the low 50s. So ticking up ever so slightly, but right around half, a little bit more than half of what the interest was back in the apocalypse days of October 2008. If you broaden that net even further, you go out to an even more generic term like portfolio protection, and you start looking at that. You pin the needle for that one back in March of 2007, so a little bit different time. Then you have a night below at 99 of February 2005, which is interesting. March of 2017 is a 90. February of this year, actually half of what March 2007 was, pretty much 51, which is very surprising. And then right now we're at a 68. So we're actually higher right now in terms of interest in searches for portfolio protection than we were back in February of 2018. And maybe a thing or two happened this February. So something to pay attention to. And if you search for something super specific, like just VIX, hey, what are people looking for VIX? What's the deal with VIX? This February obviously pinned the needle for that at 100. Right now, comparatively, we're at an 18. So maybe today's numbers might change that. We ran this a few days ago, so maybe today's down move will change that. But we were hovering at not even 20% of that high back in February. So at least so far, people seem to have more interest in hedges, but not as much interest in VIX, which is counterintuitive, which is, again, kind of the nature of the beast when you're talking Google search data. Sometimes it isn't always the most straightforward of things out there. Speaking of not being straightforward, we're going to mix things up for you today. This is usually the portion of the show I say, okay, it's time to toss it to the old odd block segment. But as I mentioned earlier, I'm down here at the Securities Traders Association conference. I've been pretty much in a room, locked in a studio, talking to people for days on end. So didn't have a lot of time really to run the old Eye of Sauron and check what we had going on. We have some stuff on the site. I haven't had a chance to even parse that. So quite literally, we don't have time for an odd block today. But what we do have time for, because it's his birthday too, we thought we'd do him a solid and let him have a extra special second strategy block of the week. He already did one on Monday. Plus, we're going to be off on next Monday because of the holiday. So it's kind of a double bonus for him. So we're going to give you more of what you crave, listeners. It's time for a second edition of the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
Uncle Mike, sir, I don't know if we had a chance to run a poll for you today, so it's kind of dealer's choice. You get to pick whatever you feel like talking about, sir. Today, I hand you a hot mic. The floor is yours. I'm a little nervous. Have at it, sir.
Oh man, this is always scary when you hand me the hot mic like this. But I have something that I want to talk about that I think I want to do two strategies actually today. We'll do a 2-for-1 on the second one of the week in honor of National CB Day. So with that, first thing I want to go through, what if, and this is one we've done on the show before, but this is just a reminder on some things. What if you own a stock, it is down in value, and you don't want to sell the stock per se, but you just want to be able to, you're thinking of maybe buying some more of it, but you don't really want to put on any more risk on the table. Well, one thing you can think about is a 1-by-2 ratio spread. So for example, let's say you bought XYZ stock at 55, stock is down at 50, let's say, and you still want to hold it, but just buying more of it, it just doesn't sound like a good idea. So one thing you can do, you can see if the option prices match up on this. They may or may not. Every stock is different, of course. Typically, stocks that are more volatile, this would work better with in terms of getting this what I'm about to describe. But it can still work in other ways. But just as something very basic, what you could do with XYZ stock is step one, and this is all done in one trade. You can set it up as a 1-by-2 ratio spread, but I'm going to do it I'm going to break it down into 3 separate trades. Step one, sell a 55 covered call for $1. Now, by doing that, you have that access to that $1 right away, or $100 if it's 100 shares, which it likely is, or 200 if it's 200, and so on down the line. And then step two, what you could do is buy with that $100 that you have. Let's say you got another $100 sitting on the side. You can buy a 50 call for $2 or $200. So the net cost of that 50-55 call spread that you bought is $100, a $100 debit for buying that 50-55 call spread. Now, with that, you're thinking, well, I thought I wasn't going to put any more money into this, Uncle Mike. What the heck are you doing to me? Well, what you can then do as a way of financing this trade is you can sell another 55 covered call. Reason being is that the call spread is a call spread. It's totally separate of the stock now, and you can do this in an IRA, and it's totally no additional monetary risk. You can sell the other covered call, and then what you have done at the end of the day is you have sold 2 55 calls for $2 or $200, and you've used that $200 to finance the purchase of a 50 call. Now, by doing that, you've created double leverage from 50 to 55. And let's say the stock were to go right back to 55, assuming you held everything till expiration. Now, obviously, I know we don't do that in real life, but let's just say that you did. Then all of a sudden, if the stock gets back to even, you are $5 ahead. Now, of course, there's ways with which to adjust things like this and that type of thing. But the concept is there in that you have the ability to create more leverage out of thin air, quite frankly, without taking on any additional risk. I think that's pretty exciting. And if you are looking at some stocks that are down today and you still want to hold them, that might not be a bad idea to take a look at. Now, second thing that I want to talk about, how to manage risk when vertical spreads go against you. Now, my compliance people tell me that I'm not allowed to tell you the exact spreads that I'm in anymore, but nonetheless, I'll just tell everybody this. I was in a short put spread and still am on SPY going into today. it went against me. Now, with that being said, it was one of those spreads to where it was $5 apart and I was getting a 50-cent credit on the trade. So risking it was about that, maybe a couple pennies higher or lower. I forget exactly what it was, but with that, not going to bring out the old spreadsheet to dig up the exact number, but nonetheless, the concept is there. Risking $4.50 to make 50 cents by selling an out-of-the-money put spread. Now, I like selling put spreads on when the market's taking a dip. I did this one a couple days ago, got into it, and now the market was going against me. Now, with that being said, I could still be in this exact same spread right now and still have the spread be out of the money. Once again, I want to repeat what I said. I got out of the spread this morning. I made an adjustment, which I'll tell you in a second, but I got out of it and I made the adjustment. Even though we've had another 15 points of downside since I got out of it, that original spread would still be out of the money, meaning above my short strike price had I still stayed in it. So why on earth did you get out of it, Uncle Mike? Why are you such a wimp? Well, I want to tell you why. The way with which I trade vertical spreads is I really don't want to get my face ripped in. There's two rules to trading vertical spreads for credits like that when you're selling them out of the money. Rule number 1, don't get your face ripped in. Rule number 2, don't forget rule number 1. If you follow those rules, then chances are you're not going to get your face ripped in if you can, as long as you can avoid a gap down. So what I did this morning is I got out when the loss on the original spread was at roughly 40 cents. So in other words, I got out of the spread for 90 cents. I got into it at 50 cents. I got out of it at 90. And I did that because of the fact that I don't want to get my face ripped in. And if I lose 40 cents on a trade, not a big deal. Or 45 cents, not a big deal. It's not good by any means. It's not fun, but I know I'm going to live to trade another day. Good part about that, I managed risk. I got out of it. The bad part is I had to feel pain today. I could have easily stayed in that spread and said, you know what, it's out of the money. So long as the market doesn't go down anymore or stays up and doesn't go down another 20 points or whatever, I'm fine. I'll wait until the end of this expiration and I'll be just fine. I had roughly 20 points of cushion I would have had when I got out of this. But I got out. And the reason is that I like getting out or making adjustments when I lose about what I was going to make on the spread itself. It's never going to be exact, or I suppose it could be, but seldom is it ever going to be exact. But my general rule is that if I'm trying to get 50 cents on a spread, I want to get out when I'm going to lose 50 cents. And in this case, usually I get out at about a dime if I'm profitable. So in this case, it's down roughly 40 cents. I got out. Now, with that being said, I have had very minimal delta on the table over the course of the last couple of weeks, today included, for the overall portfolio. So I still got to have some positive delta on the table because of the fact that, well, I'm a bull. I got to have positive delta on the table. Otherwise, Mark and Mark will make fun of me. And it's part of the trading rules that I have. So what I did was I just sold another spread on another roughly $3 lower, same expiration, same distance between strikes. Now, if it goes down again, I will get out of that spread again, and I will either roll down or I'll make some type of risk manage adjustment. But my point is that when you're trying to make 50 cents on a $5 spread, you got to be nimble on those things. And I cringe every time that I have to go over a weekend with those. And I don't cringe, but I mean, I really, it's something that I try not to do too much. And if I'm in doubt on a Friday afternoon, should I get out of this thing? Should I stay in it? I get out because I know that the gain of what I'm going to get is minimal, but the loss is going to be huge. Once again, 40-cent loss, I can live to trade another day on that. I have a $5 loss. That's going to be a lot of nasty phone calls from my clients, and I don't want to take those phone calls, quite frankly. So once again, when managing risk on selling an out-of-the-money vertical spread, whether it's to the call side or to the put side, I'm going to just make this very blunt and very simple. Once again, rule number 1, don't get your face ripped in. Rule number 2, don't forget rule number 1. And that is today's National CB Day edition of the Strategy Block.
Breaker. That was a good strategy block. Over, sir. Well done. What's your 20? Oh, wait, you're in St. Charles. We know that. Your 20 never changes.
Yeah, no kidding.
Except for next week when your 20 will be in, I think, Raleigh, right? So mixing it up next week.
No, don't you know Raleigh's actually coming to St. Charles?
All of Duke University is coming to St. Charles.
Yes, all of the So they're magically opening a wormhole so that Mike can stay in his office.
Speaking of magically opening a wormhole, I'm about to do just that because I'm going to rip the cover off here of an extended edition of the Mail Block. Could be kind of scary, so let's go for it. Let's bring on your questions. It's time for a super crazy mega edition of the Mail Block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is the portion of the show where you guys take the reins. We always get inundated with questions, and I always feel bad. We don't have a lot of time to get to as many as I would like. So I thought while I'm here on assignment, let's do just that. Let's answer some of your pressing queries that are lighting up your collective tapes, and therefore they're lighting up ours as well. And what's fun about it is you guys take us in all sorts of weird directions and interesting things that maybe we hadn't considered or thought of, like our first question. This comes from David Kotlyar. That name sounds familiar. He's written in before, I believe. And he says, "Hey, Mark." Well, hey back at you. He goes on to write here, "Could you discuss the June 2019 400 SPY calls? Very cheap and getting some love." And he puts in parentheses here, 5,000 plus contracts open. So while Uncle Mike was regaling us on all things 1x2s and ratio repairs and all that goodness and downsides and fun stuff, I was looking at June upside here in SPY. And lo and behold, our eagle-eyed, keen-eared listeners are indeed correct. The June 400 calls in SPY right now have 5,347 contracts open. They are a nickel bid at 8 cents. And interestingly enough, my data here on my screen only goes back 2 months, but these calls have been open at least 2 months. They traded a little bit earlier this week. They traded actually last week, the 26th. Only about 40 of them went up for prices around 8 cents or so. But that looks like that OI has been open for some time. I don't know, Mr. Meatball, if you want to do a deep dive into the back history of that OI, go ahead. But I only see 2 months here on my screen, and it's been open for at least that long, which is interesting. Also worth noting today, as we're talking, actually, the 3.5 calls in June also getting some love. 3,000 hitting the tape right now at prices looks like about 28 to 30 cents. That's pretty much that was at the top right here because they're 24 at 27 right now. So the 3.5 calls lighting it up today, 3,000 times. There's 26,000 contracts open there. 3/4 have 50,000 contracts open. The 400s comparatively small, 5,000, but still interesting paper. All this a long way around to saying, Mr. Meatball, is this Carmen line? Is this the new version of the Jan 10 put in VXX? Only instead we're talking upside in June.
Yes, that's all me. I'm all over it. I can't believe you sniffed out my paper. In other words,
that's totally
no.
You. You know that was you. Yes.
Yeah. In other words, no, not me at all. But it's interesting.
What do you think about this crazy upside?
It's a hedge, right? I mean, that's probably what it is. So, I don't disagree with that. You can see that clearly there's some reasons to be hedged right now.
Keep talking. Someone's at my studio door here. 1 second.
So, someone's at the studio door. So yeah, I mean, a lot of this stuff is hedges. That's the thing I think a lot of people always forget about these odd blocks is you got to always remember the stock.
Yeah, there's a lot. Oftentimes there's other things having to do with it. So we can go on and talk about this a little bit more. While President Trump's wanting to ask if he can get on our show because Mark is in D.C., so it's probably who it was.
Oh,
at the door,
that's true. Hey, I heard.
Yes, it was. You know who it was? It was a politician coming here to offer me all sorts of exorbitant bribes and things. No, actually. He can't come on the show, of course, because he's prohibited by law. But you might want to take a guess. He's actually an old friend of the program. I'll give you a hint. He used to like a lot of upside and Groupon, like nickel calls and Groupon. That was like his thing.
Oh, geez, that
guy.
Can
you take a guess who it might be?
Yeah, I'm going to guess his first name starts with a J.
Starts with a J. You are correct.
All right.
Jose Grigoso. Yes, he is here listening inside.
Hello.
He is actually laughing at you right now. He says, "Oh, that's Sebastian, that guy."
Tell him I said hello, and I miss the sweet melodic sound of his voice.
He says he misses the sweet melodic sound of your voice. Mike says he does not. Mike says doesn't miss you at all. Yeah, Tosaw still there. All good things continue, sir. We'll have to get him on the show, get him in trouble over there at Schwab one of these days. That's kind of what we do here. Let's see. So you guys tackled those upside calls there, I hope here. Let's go.
Yeah,
here.
We're good.
Here's an interesting one. Speaking of what we were just talking about, we have a lot of questions here about on a similar theme, this time on OI. We've got JL Smith. He wants to know, how important is OI when you're trading options? Are there other indicators that you focus on instead? I touched on this a little bit before. We talked about this many times. There are other things that are as important, if not more. Of course, the spread being big amongst them. But Uncle Mike, let me start with you. What are how important is OI to you, sir, when you're slinging them options?
Not very. As a rule of thumb, I mean, if I'm looking to kind of jump on someone else's trade, I mean, that's typically not the game that I play, and a vast majority of the contracts that I trade are in SPY. So typically, I mean, I have a hard time believing that 80% of all U.S. business and commerce is going to be affected by someone putting up a 5,000 lot in the July 288 puts or something like that. So I typically don't look at it. Where I think it is important is if you are going to trade things that are a little bit less liquid than the SPY, if you're going to trade individual stocks or that type of thing, I think you need to look at it. And I mean, I would never want to touch anything that didn't have something below 100 in open interest, unless I knew that I was just going to sell the option or sell the put just to get into the stock and just let it be assigned to me or something like that. But to actively trade something below 100 open interest, I would never do that. And quite frankly, I probably wouldn't do anything below 1,000 open interest.
Mr. Meatball, same question to you, sir.
Yeah, that's key. I mean, I don't pay attention to strike open interest, but you got to make sure that you're not entering a Roach Motel. And where, it's going to cost you 25 cents to get in and $1 to get out. So that's where making sure there's some open interest available is important. But outside of that, it's not that it's not something I'm overly concerned with.
I'm getting distracted here by our fellow cohort here. He's asking me all these questions while we're answering questions here on the show. Yeah, okay. Good seeing you guys both here. We'll have to get him back in trouble on compliance. Yes, he says hello to you, both of you gentlemen, and he also gives you some appropriate finger gestures, which are let's go. Let's see here. Some more here going on here. Let's see. Here's a fun one from 10761. He wants to know, are we in the midst of a major correction? Mr. Meatball, I'll let you feel that one while I go close the door here.
Are we in the midst of a correction? I mean, today looks like a nice sell-off, but I don't think it's the end of the world. Rates are moving. We've talked about the fact that a structural sell-off in interest rates, where hedging within rates itself versus junk bonds, I'd point out HYG not having you think that bonds in general are having a bad day? Take a look at distressed debt off 0.5%. That you're saying 0.5%, that doesn't seem like a lot. It's a lot more than you realize. And so I think that you've got some risk within the distressed debt, but bonds are moving, and TLT is moving, and that is the what matters is that rate of speed. If we get some sort of crazy rip higher in rates, then we could have a correction. If we don't, and things just kind of continue with where they are, I think it'll be fine. It also matters how good non-farms are tomorrow. With higher interest rates and higher inflation, you need growth.
All right, I got rid of those very distracting elements here, so now I could focus a little more on what I'm doing. Mr. Uncle Mike, what are your thoughts? I'm guessing you're the perma bull. You said it was kind of like a one-off thing, I think, earlier. So are you panicking like our friend 10761?
Plenty of reason to panic. You need to get out right now. Don't do anything. Run, don't walk to the nearest phone. Say, sell, sell, sell as loud as you can. Oh, wait, sorry. I said that backwards. No, I don't think we're in the midst of a correction, because if anything, if we may be in the beginning of one, that we don't know, but today's just one day, and we're at 288 right now in SPY. We're $5 away from the all-time highs of the markets for SPY, and 3 of those dollars that were down or that were away from it were just down today. So we're less than 2% away from an all-time high. So I think you could make a case this is the beginning of the correction. Who knows? You might be right. Today might be the beginning of the big correction, taking us down to the 280 levels. But in reality, I don't think it is. But we'll see what happens with what Mr. Marks has to say about the bonds. Very interesting.
Well, yeah. And you know what else is kind of interesting under the radar story is this Chinese chip story. And one of the questions that I think tech companies need to start asking themselves is, at what point is the risk of the Chinese government of the manufacturing risk, IP risk, spy risk, all of that actually outweigh the cost savings of building in China versus, let's say, the United States or Mexico or, Japan or Korea or Bangladesh? I think that, you look at these Chinese tech names. If you want to know part of what's pulling off the NASDAQ is there is, a couple of these contractors that they work with in the NDX that are Chinese companies are getting absolutely slaughtered today. And the Chinese market is off 3% today as well. So, in addition to kind of interest rate risk, this whole Chinese spy ring, this is there continues to be these different shoes dropping that make the cost analysis of building and selling in China, a new. In need of a new analysis kind of weekly. It's something like this is popping up almost every week.
Yes, it certainly is. And speaking of popping up, we got more questions popping up. We got one here. What is this? Just Incredible. I like that handle. Just Incredible. He wants to know, do we have any thoughts on the BBD November calls? Nice Brazil stock rally going on. Not so much in this one today. This is ticker symbol BBD. Of course, this is Banco Bradesco SA. In case you couldn't guess, this is an ADR. Trading $7.80 today, off about 20 cents or about 2.5%. So maybe longer term, a little bit of a rally. Obviously today, feeling a little bit of the heat that we're seeing over. This one actually looks like it's been relatively around this level for at least the last couple of months out here. So interesting stuff out here. This is the name that does about 8,500 contracts a day. Today doing 20,000. So lighting it up today. So you have good timing on that. In terms of what's lighting it up, you are right. There are some Nov calls lighting it up to the tune of 2,500 of the Nov 8s. So just slightly out of the money calls going up here for prices around. Let's see if I can pull up this screen here for prices around. That's the wrong strike. Here we go. Now 8s. They were up for prices. 2,500 of them going up today for prices. Looks like around 60 odd cents, 65 cents. Looks like paper was indeed buying a good chunk of those. If I can get my screen to cooperate with me. There we go. All right. Yeah. So also we saw some kind of actually maybe a little bit of mixed paper on this as we see some of the lighter kinds. The bigger blocks though seem to be probably paper. Actually, it might be paper selling 73 cents on some of the earlier kind before the stock maybe took a little bit of a hint. 500 blocks of 73 cents, 400 lots. So it's like the lion's share actually went up around 73 cents. Total of 2,500. That's on OI of 21,000. Worth noting, these calls have been fairly active over the last few weeks. 2,500 going up today. So that could be indeed closing on some of this earlier paper. We saw 4,000 going up on the first when these calls were around 32, 33 cents. So they moved quite a bit, nearly doubled since then. So there could be some profit taking there. We saw 1,600 going up for around 40 cents on the 28th. We saw 5,000 going up on the 18th when these things were around 40 cents. And also about 5,000 going up when these things were around 30 to 35 cents. So interesting, a lot of paper, 21,000 open. Again, all of that was pretty much additive to the OI here. The OI back in early September was only about 4,800 contracts. So it's all grown substantially. All this 20+ thousand contracts is open now, 25,000 most of it has been opened in the last couple of months. So I wouldn't be surprised if they're taking some of that off the table here. Mr. Justin Credible. But we're kind of burying the lead here because the big trade actually today out here isn't in the Nov calls. If you scroll down a little bit to Mr. Justin Credible, you'll see today's big trade of the 20,000 contracts that are going up, 13,500 pretty much of them are the March 7 puts. Someone blasting out a pretty sizable line in the sand. Like I said, 13,500 roughly going up with big chunks around 56, 57 cents or so. So it seems like open in paper, they're at 56 cent bid out at 60 for these things. 9,900, so decent OI, but all open in paper here. So it seems like more so than buying the calls today, which they certainly probably have been on the upside. Someone is turning around and putting an aggressive line here in the sand on the downside to the tune of the 7 strike here. Let's pull up a chart for a year out here in BBD. I'll confess this is not a name that I follow every day. We talk EWJ, we talk other international names, usually on the ETF side all the time. Not so much BBD here. A year ago, this name was trading almost $12, $11.75. Got up to as high as $13 back in January. Then we all know what happened after January. Got down as low as looks like 6 and change back in June. Actually flirted with those levels again back in September. So it's kind of been all over the place, this name. Seems like we got an aggressive line in the sand, Mr. Meatball, along with some upside buy-in. So bit of a time maybe bullish risk reversal going on here. What's your thoughts on this name, if you have any, and then B, the paper we're seeing?
I mean, Brazilian banks are interesting. Brazil had actually had a really nice rally the last couple of days. I had not seen this specific trade, but, it could be somebody that's looking at today as an opportunity to, do some scoopage, if you will.
Yes, do the old scoopage. Uncle Mike, you play in Brazil. You got any thoughts on this paper or this name?
No, I think that might be some scoopage, as Mark is saying. Typically stay away from Brazil.
Interesting stuff going on out here. Sounds like Valentino likes it.
Yes, Valentino. He's been heavily invested in Brazilian banks.
I've heard he's a huge lover of these Brazilian banks.
Actually, I'm on the line with Valentino's investment advisor as we speak.
That's right, and his investment advisor says he is not involved in any Brazilian banks, at least to his knowledge.
All right, Uncle Mike, I usually steer away from these kinds of questions because they could end up in very long discussions, but we got a little time today, so I thought we'll allow these guys to come on as well. We got KBX32, very creatively named here. He's got a simple yet a deceptively simple question because it could be very lengthy. He just wants to know very simply, what is the cheapest way to hedge his portfolio with options? So there you go. Easy question, Uncle Mike. Have at it. You got like 2 seconds. I'm just kidding.
Okay. Hit the sell button. The easiest way the cheapest way to hedge your portfolio. Well, I would say the cheapest way is by typically using collars on the individual names. One thing that we do with our strategic night portfolio, we do have a hedge leg to it, meaning if the client wants to be hedged, we'll take additional capital and we will buy puts, put spreads, or whatever we deem needed on SPY. So that way, if we have a major market meltdown, then we're hedged from that standpoint. Now, the good part about that is that if in theory the strategic night beats the market, which, by the way, it usually does, then it's a good, cheap, efficient way of hedging against a market meltdown. Now, the bad part about that is that you're going to need additional capital to do that, meaning that you're either going to have to pay margin interest if you're trading on margin, which we don't. But if you are, you're going to have to pay margin interest, even if you do have a PM account. And you'll have to take on the additional funding. Now, if we were to just collar every individual stock within that portfolio, two things would happen. Number one, I'd blow my brains out because I would just go nuts trying to do such a thing. But number two, you're going to have the benefit of using the premium that you collect from the covered call to finance the cost of the long put option. So if you have the covered call sold against an individual name, it's not going to cost you any additional premium or any additional money out of your pocket. You're just simply giving up some upside on the stock. So in terms of the cheapest way to hedge your portfolio, doing collars on the individual names would probably be the cheapest way of doing it. Now, of course, there's disadvantages to the collar as well, meaning you're going to give up some upside. Of course, you could maybe use call spreads as a way of financing the long puts. So that way, if the stocks do go way up, you can still have some potential upside on them. And there's other ways of doing it too. We had a pairing strategy many years ago at RCM to where we would buy stocks, and the other way with which you could do it would be to go short S&P futures. Now, granted, that's not going to be a lot of maintenance requirement for the futures, but it's something that we don't do this now, by the way, but this is something that you could do as well, to where if the underlying were to stay the same, then it wouldn't cost you anything because futures don't have time decay the way that options do. So there's a lot of ways of doing it, but I would say the cheapest way of doing it is to just do collars on the individual names. But if you want to do something on the entire portfolio, you can do, I would say, either buying options on an index. So maybe your portfolio doesn't necessarily track the S&P. Maybe it's more of a tracks the NASDAQ. Then you can look into buying options on the NASDAQ or the Qs or something like that. Or you can do something along those lines. Final thing that I would like to mention on this is I'd recommend.
Mike, I was just going to throw out a similar idea. Like, if you really like the names within the individual industries that you are, so like, let's say you think JP Morgan's better than the rest of the financials. If you don't want to collar JP Morgan, you can actually collar XLF or some of the individual ETFs to deal with your portfolio's concentration. That's another alternative that allows you some of that alpha, but takes away some of your beta, which is really what Mike is pushing, right? If you're using SPY to hedge your great picks, then you're still capturing alpha. You're just taking your beta away.
Yeah, the disadvantage, of course, is that you have to add additional maintenance, but there's plenty of ways to do it.
Yeah, that's why those questions like that are deceptively simple yet kind of fun. You could spend a whole show talking about that. There's the collar, like you mentioned. There's collars with kickers for a little bit extra income. Oh, Valentino likes those. And then,
I was going to say, like, we don't get our. I was just going to say, I'm a little disappointed that when I mentioned alpha and beta, Mike Tosaw didn't go nerds because of the alpha beta.
Yes, the alpha beta.
I keep expecting him to go nerds.
I can see Uncle Mike having such a thought process. Good questions, everybody. We like them all.
My hero.
Broad, vague, specific, all sorts of fun stuff. We got more here, but we're actually running out of time, surprisingly. So let's keep on rolling into our final segment. Yes, it is time indeed for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, ladies and gents, as we mentioned at the top of the show, this is indeed the portion where we talk about what's coming up. And we mentioned earlier in the show, a lot of things popping off tomorrow, including some things that if you are indeed a farmer, don't pay attention because it doesn't concern you. For everybody else who is not a farmer, indeed, perhaps you would consider yourself a non-farm employee, then perhaps you might want to pay attention. Uncle Mike, is that you? Are you indeed a non-farm employee, sir?
I am a non-farm employee.
So is that what you're watching tomorrow?
I think I might. That's actually one of the highlights of the first Friday of the month. Just checking out and looking at my phone at 7:30 while being at the gym and seeing what's happening.
I think that while with the move in interest rates, tomorrow does matter a little more. We need to continue to see growth. Otherwise, you got to ask yourself, do we have inflation without growth? And that would be problematic.
Yeah, I was going to say the same thing, that this is obviously puts a little bit more of a microcosm on that number tomorrow. Usually non-farms are, I wouldn't say kind of a non-event, but pun intended, but they kind of been a whimper of late, certainly a shadow of their former selves. But this number, this move in the rates, all this brouhaha going on today puts that number in a little bit more of stark relief. So it'll be interesting to see what is cooking going on over there. Unfortunately, listeners, that's all the time we have here from our studio in D.C., our studio in Chicago, and from our many and varied, I should say, places in and around the hinterlands of Chi-Town. I want to thank you for joining us. Let me go back around the horn one last time. Let's start with Valentino. What's he got cooking for us, sir? What's Valentino up to? Mr. Meatball,
Valentino is on his way to Grand Haven shortly after this show. And but really, if you'd like a free trial of Option Pit, I would love to set you up with a 2-week trial. Feel free to reach out to me, mark@optionpit.com, and I'll set you up with a free trial. And then on the 15th, I'm doing a presentation with Stephen Place of Investing with Options. We're going to be doing what we call the easiest short unless you blow up your account. And we're going to go through some VXX trading strategy.
Good old VXX. Looking forward to that. Check it out, optionpit.com, to learn more. The music's coming hot and heavy here. The old thing. Maybe there we go. That's a lot better. Thank you. All right. And Mr. Uncle Mike, sir, last but not least, what is cooking in the land of St. Charles Wealth, a.k.a. the land of the Fox?
The land of the Fox is traveling south down to Raleigh-Durham. I'll be speaking at Duke University on Wednesday this coming week. So if you're interested in attending the public session, go to my Facebook page at St. Charles Wealth Management. You can sign up for the 7 o'clock event that evening for those of you in the Raleigh-Durham area. And also we'll be broadcasting the show on Wednesday next week, but very excited about it nonetheless.
Yes, as you alluded to, there'll be a show, a little bit different week next week. No show on Monday due to the holiday, so everyone is out and about and hither and yon, so enjoy yourselves. You get a best of in your feed, so we won't forget about you. And you'll have other shows hitting the network, just not good old OB. And, of course, a ton of interviews coming from this event, so you'll have your content fix over the next week or so. And, of course, we'll be coming at you on a little bit different day next week on Thursday, Wednesday, as opposed to our usual Thursday. Because, as Uncle Mike alluded to, we're coming at you from, I'll be back from D.C., but he'll be taking my place in the South here, down this time in good old Duke for a little bit of fun. Maybe we'll get some fun student interaction, too. They'll want to know, what is the cheapest way to hedge my portfolio? And we'll start that whole conversation over again. So it should be fascinating stuff. Stay tuned for that. And also, if you listen to us live, stay tuned. We got a little bit of a respite here. Go get a beverage, hit the restroom, and come back in about half an hour. We'll talk all things vol and indexes and rates and metals and all sorts of fun stuff, because we'll be talking TWIFO in about 30 minutes. So see you then. Otherwise, we'll see you next time for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.